everyone. Thanks for joining Join Custody. I'm your host, Ben Duve, former banking executive, central banker, and now global head of partnerships of GK8 by Galaxy. And I'm joined by the lovely Emma. And Emma, maybe you introduce yourself. And it's great to have you on with so many offline discussions now to also do it in this podcast format. Thanks for joining us. And thanks for the audience for joining us and listening.
Thanks, Ben. Hello, everybody. My name is Emma Lovett, and as Ben introduced me, I actually work at JPMorgan in the markets digital assets team.
Great. I mean, it's super interesting bank with so many different digital streams. Important is the market bit, and we will discuss and dive into that a little more in a bit. But I think the most important question many people ask, and we always ask, is how did you get into digital assets?
So I'm sure everybody's got a long story. I've actually been working at JPMorgan for over 20 years. I started at JPMorgan on the fixed income syndicate desk, and essentially what we did is we worked on behalf of corporate issuers, so large corporations like large banks or companies like Apple, McDonald's. And when they needed to borrow money, much like governments need to borrow money, so when these large corporations needed to borrow money, they would issue bonds. And I was on what's called the syndicate desk, and we were in effect the new issuance desk for putting these bonds together. Because the bonds are so big, they're often in the billions of dollars. There's usually a group, which is why it's called the syndicate desk, because instead of banks actually competing against each other, what happens is you join a syndicate. So you're mandated with 2, 3, or 4 other banks in a syndicate, and you work together on behalf of the issuer to issue their bonds. So I was doing that for almost 20 years at JPMorgan. And then JPMorgan started looking at blockchain quite early on, but that was mainly out of the payments division. They had their blockchain digital payments, or as it was known then, Onyx digital payments, and also their privately permissioned blockchain platform, Onyx digital assets, which is now Connexus digital assets. But what we started to see on the market side was that there were some frequent borrowers that were actually starting to issue digital bonds. So EIB was one, HKMA was one. And so at that point, I actually moved over onto the markets digital assets team to build out what started as an application in order to to facilitate the issuance and settlement of digital bonds. So it was a good segue because it sort of capitalized on my experience of new issuance bonds, but the blockchain part, the whole sort of digital element, was completely new to me.
That's an interesting one. So basically, they needed an expert. You joined, and now you're the digital person for the market side of JP. I mean, that's a good run there, right? And I think it's you lead the credit side, right?
Yeah.
For me, the interesting bit is what does it mean day to day, right? And what can people imagine what you do, what you look at day to day, you as a person, but also JP as a bank, right? So you work, you build products, or you work with issuers, buy, sell side, or you design the rails, or a little bit of everything. Give us a little flavor of
all of
what
the
you
above.
what you do. Then pick a few interesting topics maybe to dive in that you did over the last months, just to give a little bit more of a feel, because I think a lot of people know the Connexus part, but not the markets part. Even though I think you have quite a big stake in the overall ecosystem of JPM.
That's it. And I think it is understandable, and so what our division do is essentially we sit within markets. So I actually report up to the head of trading, and the sort of the crux of our desk is to look at how we can make markets products more efficient by using blockchain technology. And I think the first business use case for this, and the first one that JP Morgan developed, was the intraday repo application, which is now called digital financing. And that is a business case where, lots of people are sort of looking for use cases using blockchain technology. And I think that that's an obvious one because it's something that you can do that can only be done using blockchain technology. So in traditional infrastructure, repo tends to be done overnight, because the mechanics of it, on a trade ticket, you have a settlement date, whereas using blockchain technology, you can use a settlement time. So you can now do an intraday repo trade. So, participants agree the length of time, anything from, well, any time at all, but typically something like 4 hours. And you can then borrow or lend money intraday. So you can sort of, instead of having to wait overnight, you can do it intraday. And that was the first.
That was always the dream. I ran a custody business, intraday liquidity. That was always the dream for so many years. Intraday liquidity, either to charge for it or get extra intraday liquidity. There were two sides of that story, right? I mean, I remember the custodians when they had the issue, they needed to pre-fund the settlement cycles and so on. They didn't know how do we charge for it because there was no market for that intraday liquidity, really. And on the other side, people wanted to borrow or wanted to get more out of excess liquidity people had lying around during the day because you might only need it for a few hours during
Exactly.
trading times.
Exactly. So it's sort of like the perfect use case. And, obviously that sits really clearly within markets. And, we see that used a lot by different bank treasuries. And as, the Basel rules and Basel III, the regulation there around making sure that you have capital that you can use just in case something happens, the use of blockchain technology sort of introduces more of a concept of just-in-time funding as opposed to just-in-case funding. So, if you think about, they're dealing with, billions and billions of dollars, and even small basis point charges overnight on that are quite demonstrative. Whereas being able to, sort of negate the need for that and just have something intraday, is a huge efficiency in the market compared to what is
It's
available in traditional infrastructure.
it's a lot of money, right? I think the
It's a
difference
lot of
is,
money. Yeah.
and that's what I always my question is, right? We get fixed income is the largest asset class overall in the world, right? These bonds, these assets are actually the majority of assets created, but they don't get really the hype currently, right? We have the equity, the fund pieces, they're really hyped. And then, but you have that fixed income. You just described a use case which makes huge volumes and makes huge amounts of money by saving just a few basis points. What is holding out, but what is holding it back? Because on paper it's a perfect asset class, or is it already moving on chain and nobody talks about it because it's all us, me, maybe my prior roles, the boring traditional bankers who just make things efficient and make money, but don't talk about it as much as the flashy, more retail focused parts of the industry.
So I think the intraday repo application is actually growing at some scale. Obviously, JP Morgan are not the only ones with their platform. We're seeing a couple across the market. I think sort of turning into the broader sort of fixed income question and then sort of going back to the digital bonds. So alongside the digital financing application, we've also built an application called the Digital Debt Service, which is the application for digital bonds. It can be any sorts of digital debt. So from short dated to structured, whatever can be done on this application. And in terms of the day to day, we work very closely. We've got a dedicated tech team who they're just fantastic, and we work very closely with them. But we started with a blank piece of paper. We developed. So when I say we, it's me and my team developed the application, the operating model. We work very closely with JP Morgan Custody, because JP Morgan Custody were a key partner for us because, of course, investors need a custodian in order to hold these assets. And that application sits on top of Kinexys digital assets. So once it was ready, we then went out to issuers and investors and put a transaction together that was then launched through the digital debt service. So my job encompasses everything from sort of a product lead to sort of more coverage, and sort of everything in between. A lot of it as well, particularly in the early days, was thinking sort of quite educationally, both internally and externally. We wanted to put an operating model together that we felt was pitched in a way that used blockchain technology to as much as we possibly could, while making it not a huge uplift for the issuers or for the investors. So the application can be just accessed via a URL, for example, instead of anybody needing to do their own internal tech build. But there's still a lot of education that needs to be done, not just from, say, trader to trader or investor to investor, but with the whole controls teams, with risk teams. We really had to make sure that we were able to articulate why we were moving this onto blockchain technology, what was the point of a digital bond, and what the key differences were, to give comfort to those controls teams, both internally and with our clients, so that they felt comfortable that these kinds of transactions could then move on chain. And so that's sort of the day to day. You'll notice that I talk about using Kinexys digital assets. That's obviously our privately permissioned blockchain platform. Much of the work that our team on markets digital assets have done has been with Kinexys digital assets as our key partner. When I started back in 2022 on the desk, they were one of the only blockchain platforms that had a digital payment rail. So again, we work closely with Kinexys digital payments, so that it's delivery versus payment, immediate delivery versus payment settlement on chain. And obviously we are a regulated bank and all our activity is regulated. So we really had to be sure that that everything that we were doing came within sort of existing regulatory frameworks. At the time, that obviously was, it was most obvious for that to be on a privately permissioned blockchain platform. Particularly the US regulators seem to prefer that platform because it's owned by one institution.
You
And
can hold one person responsible or
you
one
can hold
bank, and you
one.
can add somebody has to sign. You can arrest that person to release something. I mean, there are very practical implications from a
Exactly.
regulatory perspective on that. Yes.
Exactly. The accounting, the governance, everything is held within one institution. And so,
Yes.
so we weren't alone. There are other banks with their own privately permissioned blockchain platforms, and they also started their activity using these platforms. But I think we have started to see the sentiment change. Obviously we've got the Clarity app, we've got Genius and Clarity. In the UK, we've got consultations by the FCA to look at stable coins, and all that work is now starting to allow more activity on public chain. So, to date, most of it has been on private chain, but I think going forward, it looks like there'll be more activity on public chain.
So the question there I have, right? Because my question is, what does hold credit markets still back, right? To move more on chain. Is it that the private chains means you have to be a JPM client and happy for JPM to run the infrastructure? And I think that looking at the client base, it's not a small bank. There are a lot of people who are willing to do that, but it creates a little bit of an island. And the moment those assets, liquidity move on more public chains, or at least have a gateway between both worlds, more people will move on chain, more assets will move, more liquidity will move on chain. Could the public chain be an opportunity or does it alleviate a roadblock that existed before, or what else do you think needs changing or is needed to get more credit on chain?
I think that's absolutely it. So for the privately permissioned blockchain platforms, clients need to onboard onto those platforms. And I think that there are some of the CSDs have got their own platforms, a number of banks have got their own platforms, and particularly the investor community was sort of challenging those that own the platforms and saying, are you expecting me to onboard onto 14, 15 different blockchain platforms just so I can buy and sell and trade these securities? I don't want to do that. That doesn't offer me anything sort of better than I have today. I already
Well,
have to
I have
open
a former
accounts with.
employer who would say, just come with us and we globally orchestrate all of that for you, right? I mean, I might defeat a little bit or parts of the blockchain, but there are places in the world, roles in the ecosystem, which basically connect you to everyone and everything. But yes, sorry, I cut you off there. I saw this
No,
just
that's true. But I think that I think particularly back then the prospect was is that you would need to onboard onto these different
yes,
platforms, and the problem was is the platforms don't talk to each other. They work as their own internal ecosystem. Partly because of the governance around it. How can somebody that buys something on BNP's platform, how do somebody like another bank like Goldman Sachs, how do they get comfort with that client unless that client is one of their clients? It sort of introduces these
yes.
questions. So, and also the more chains you have with those interoperability, it becomes a bit more fragmented, and the whole reason why
Well,
we're sort of doing this is to
it's like
remove
the
the
traditional model, right?
fragmentation.
Yes, it's the
Exactly.
traditional model. You have many different CSDs and other venues, and then you basically are in a walled garden within that ecosystem to a certain extent, right? I mean, there are bridges, there's certain ways to do it, but yes, you're right.
it, it,
We
it,
we
it,
tr
it potentially introduces some vulnerabilities.
yes,
So
agreed.
blockchain platforms are great. And, I don't think that I don't think people are putting privately permissioned blockchain platforms down to only work on public platforms. But I think that we're starting to see a move perhaps to more of a hybrid option, and it is still very new. Public blockchains, well, for starters, there are still capital requirements that are inflicted on,
Yes.
sort of, banking regulation and everything. So it's not like, there's a green light and everybody goes off. I still think that we are some distance away from seeing large asset managers move assets at scale onto public chain. But I think that, there is recognition that the privately permissioned blockchain platforms were fantastic for getting started and sort of really giving everybody a taster as to what this technology can do, but that the liquidity limitations really were quite a challenge. And so that
That's the key one. I mean, nobody issues into venue with less liquidity because less liquidity means you have to pay a higher interest rate, right? Because it's very difficult to get out of your position as the asset owner. So I think it's a hand and an egg problem, or we find a way to transform the industry where the liquidity just aggregates into places. It's not fragmented to any extent because I think fragment, and I think you might have a large enough liquidity base within your own ecosystem, but it's still small compared to the overall capital market liquidity, which you want to capture
exactly.
for your clients, right?
Yeah, and also, particularly when we look at our investor clients, and by that I mean like the large pension funds, the large asset managers, they've got a duty to their clients to make sure that they're getting the best price for their clients. And if they choose, if price is affected because something is seen as in a liquid security, then that then introduces a set of complications
With
for those buy
individual
side firms.
counterparty risk, right? There's even
Exactly.
counterparty risk to the person running the platforms because they're probably not as regulated as the CSD is, right? So there's many new risks. So let me segue into my next question a bit. So when you said you talk to a lot of people, it's a lot of education, right? So you talk to the corporate treasurers who issue the bonds, for example, right? You talk to and you just mentioned them, institutional investors. Um, what do they ask when you discuss with them the tokenization of credit? What are the biggest concerns? What biggest opportunities do they see, right? Not from your banker's lens, but in their day-to-day practical application. I think that's an insight you can share very few people have because not everybody who does a little blockchain here and or has their own platform on the retail side understands what the bigger capital market really does and thinks. So I think that's a unique insight you might be able to share a bit.
So I think that there are plenty of benefits of, sort of like using blockchain technology. So I guess if we sort of like start to think about each individual user. So for for a corporate issuer or a government issuer, then I think that the real advantage is around some of the corporate actions. So the management of coupon payments, of redemptions, of corporate actions. If that moves on chain, then it can just be automated. At the moment, an issuer paying agent is used, and it's quite a manual process to work out each coupon payment, make sure you agree it. If there's been a bank holiday that's
Oh,
been
I love
added.
that. We had people, we had individual people. I remember in one of my old fields, individual people assigned for certain corporate actions, and they were the leader of that corporate action because we got different information vendors feeding us information and interpretation of a corporate action. And then a decision maker within the organization needed to look at the sometimes not 100% clear gray area interpretation of a corporate action and then take a decision as a firm that we will interpret a corporate action a certain way, and then pass that on to the client, get the feedback from the client, feed it back, and then there might be an issue because we interpreted it not the way they were. So crazy. I mean, if you're not in the depths of that, it sounds like really boring. Oh yeah, and if I talk to my new colleagues in the digital world, they all say like, but it's normal. Like you press a button and then everything goes automatically. It's calculated and it automatically goes from a wallet into the other wallet and all full audit trail, all transparency. No, no, no. This is not how it works in the traditional world. There's a guy who looks at the corporate actions and then makes a decision on how that should be interpreted and pushed out to the client base.
Exactly. So like instant operational efficiencies there for
Yes.
the issuer. Um, on the investor side, I think when you're just talking about a digital bond, a lot of the efficiencies are in the post-trade operations. So there's a lot of failing trades at the moment. If a trade fails, what tends to happen is the custodian will call the operations team at the client and sort of like say that it's failed. We don't know why. Is the trade the right way round? We had cash in place, etc., etc. If
Mandatory buy-ins, penalties
exactly.
around cash being deposition. There's a lot of money lost
There
in
is.
that.
So if you can just look at one single ledger, all participants of that trade, not everybody in the world, but just, if I've traded with you, then my operations team and my custodian, as well as your operations team and your custodian, can look at the same ledger. So you can instantly see why a trade has failed and you can put that right almost immediately. As well as, the movement towards T plus one, potentially T plus zero. It just again takes out a lot of the fragmentation that exists within the traditional infrastructure. So I think on the
Well, we have it
digital,
now in US T plus one, Europe T plus two. We already have a
exactly.
fragmentation in settlement cycles where liquidity and capital doesn't align anymore for a day. I mean,
Yes.
that's
And then, just thinking about sort of using this access to sort of one clear ledger, then you start to think about how collateral can move on chain. And actually, DTCC or DTC um, they did something last year called the Great Collateral Experiment, and they almost sort of followed what happened during the financial crisis when the Lehman Brothers Bank sort of got into trouble. Then sometimes it took people days to work out exactly what they owned when. Whereas if you've got something, you've got an instant record of who owns what to the second, then it's very easy to manage collateral in times of distress. And we've seen a lot of market volatility. And again, I think that it would give comfort to those that, sort of buy and sell a lot of securities and collateral to know instantly whether they owned something at a particular minute.
but it also, I had a lot of these discussions and people said, yeah, that's true, it's great. And you instantly know, but there's one thing people forget once in a while. I mean, in the we don't know who owns what, you can create a situation where maybe a bank doesn't fail or a participant doesn't fail because it's not very clear if he did or did not own at a certain. You buy yourself a day or two to solve it, right? I think that sometimes is an opportunity as well. But I agree with you. The certainty. instant certainty at least rewards the ones who are right and penalizes the ones who maybe took a little bit too much leeway with their capital and their liquidity.
And I think that I guess that comes back a lot of the time to I, I think that it's going to become clear that the technology can do all these functions. But whether or not the market will coalesce around wanting to use these functions is a very different thing. So yes, by using blockchain, you can trade and settle 24/7. It remains to be seen whether the institutional side of the financial services industry wants to be operating 24/7. Sometimes
And
having
what
a
the
break.
opportunity is, right? If
Exactly.
is it economically viable enough?
Exactly. Having that break, being able to make sure that your cash is in the right place. These aren't necessarily bad things. The technology allows you to do it, but whether or not the market as a whole will coalesce behind using the technology for these different use cases, I think, it still remains to be seen. So, the way that I view it in my mind is we've sort of got the traditional TradFi. So we've got TradFi just working as it is. And it's not broken, but it is probably ripe for a bit of modernization. Things still work in a very similar way to they did even prior to the financial crisis. Since the financial crisis, there was some modernization in terms of the new regulation that came on board and technology adapting to that. But we're using these CSDs that have been around for sort of 60 years. The way that a trade actually settles hasn't really changed. Like people often use first it was on paper, then it was on Excel, and now it's sort of online. But Web3 is sort of the
But there's
next
still a guy
iteration
with
of
an
that.
Excel somewhere. There's still a
That's
guy, always a guy with an Excel somewhere. That's a dirty
that's true.
secret of the industry, but there's always this one guy who has an Excel with just to make sure with all the positions
That's
and
true.
who owns what.
So we've got TradFi sort of on one side. Then I think on the other side we've got crypto, um, particularly at the moment within retail. There are huge statistics around almost as many Americans own crypto as they have a mortgage. So it's being used widely within crypto. I think less so institutionally. Of course, we've got a lot of institutional activity, but maybe not
The
by the
wallet size
traditional.
is much, much smaller, right? I think it's always
Exactly.
everybody touches it, but is it 1% or 0.5% of your allocation versus bonds, equities, and other more traditional asset classes, right? But that's the
That's it.
opportunity for crypto because it might grow. And I mean, because of the size of that investor, of those investors, right? And the assets they can, or the wallet they can allocate, just small growth in that would be huge for crypto. But I think but it works differently, right? I have to say that now
It
being
works
more on
differently.
the non-traditional side part. I mean, we talk to institutions a lot, but we also talk a lot to people who have a retail flow behind what they do. It is different, but it's what I always see is the in crypto, the individual has the same tools available than an investment banker with all the traditional tools nowadays. They can repo, get instant liquidity, they can move their assets around, they can do bespoke trades, they can do a lot of programmatic things and have a lot of tools at their disposal. Usually only institutional investors have. That's the fascinating bit I see replicating in the crypto world. The guy, you can set an investment banker into a crypto setup, and he would be able to do all the things he does in a fully regulated environment, certainly also in that crypto world. All the tools from everything is used to is available in that crypto less regulated, more risk, of course. That's the fascinating bit from my perspective.
I think so. And so, what I'm really looking at is that area in between. So, what are the tools that are being used? So, as there's more institutional adoption of crypto, say, for example, you've got a firm that uses stable coins for cross-border payments overnight, then will that institution want to use that stable coin to then buy their bonds or their equities? Where are we going to land with atomic settlement, so trading and settlement at the same time? How is the traditional financial services industry going to want to use some of these tools that will become available to them sort of on the crypto side? Because they're already well established, as you said, Ben, like they're already well established on the crypto side, but they're not well established within traditional financial services industry institutions. So it's going to be interesting to see where that world starts to sort of cross over, which parts of the technology are attractive and which parts, even though the technology is able to do it, it's sort of like, what, I'm kind of okay with things as they are.
And we are at time. You almost gave already away. We should do a second one, and then that's the next theme for the next podcast. So time flew by. So interesting. Thanks for sharing your insights, Emma. Thanks for everybody. Thanks to everybody for joining and listening in. And I hope, Emma, we talk soon in person for sure. Maybe we find now the second time when we discuss the little nuggets, super interesting nuggets you just dropped at the end, just in the
Absolutely.
last
It
sentence.
feels like it's to be continued. Thank
Yes,
you very
we do
much,
that.
Ben.
Thank you.